Imagine living in a society where your money has the amazing capacity to increase and double itself exponentially over time, opening the door to unfathomable wealth. Today, I'd like to urge you to explore the fascinating world of compounding, where modest financial commitments can result in great financial success. Prepare to set off on a thrilling journey as we unlock the mysteries of compounding and give you the tools you need to change your financial future. Compounding stands out in the realm of personal finance as a tried and true method for building long-term wealth. Compounding refers to the idea of reinvesting your profits in order to have them produce more returns over time. Utilizing the force of compounding, people have the opportunity to build substantial wealth. Compounding's extraordinary capacity to expand investments exponentially over time has led to comparisons to the eighth wonder of the world. Compounding's ability to produce income on both the principal and the accumulated returns is what makes it so magical. This compounding impact speeds up with time, leading to a large increase in wealth. The avalanche of wealth accumulation that is the compounding effect is an effective way to explain it. Let's think about a real-world example to better understand compounding's potential. Let's say you put $10,000 into an asset that, over a 30-year period, delivers an average yearly return of 8%. Your investment increases by 8% in the first year. Adding $800 to the $10,000 you invested initially, $10,800 is the new total. When the 8% return is applied to the increased amount of $10,000, $864 is added on top of that amount in the second year. $11,664 is the current total value. As the compounding effect continues, the 8% return is applied to the remaining $11,664 to provide $933.12 after being multiplied by 8%. $12,597.12 and change are the final total. Due to the compounding impact, growth gets more substantial as the years go by. The initial $10,000 investment would have increased to around $110,000 over the course of 30 years. In addition to the initial principal, interest is also earned on the interest that has accrued over the course of prior years. The growth potential of investments is greatly increased over time by this compounding impact. Compounding can provide significant wealth over a long investing horizon. Now that we have a better understanding of compounding, let's look at the 8 best assets that have contributed to the wealth and prosperity of today's wealthy. High-yield savings accounts. When compared to typical savings accounts, a high-yield savings account provides a competitively higher interest rate. Since it doesn't need a sizable initial commitment up front, this is the easiest compounding asset to start investing in. Even while the returns might not be as large as those from other types of investments, they offer a secure and convenient approach to build wealth. For instance, if a person invests $10,000 over the course of 10 years in a high-yield savings account with a 2% annual interest rate, assuming that the interest is compounded annually, the investment could increase to about $12,128.9. The interest can build up over time due to the compounding effect, which helps the account's total growth. Savings accounts with high yields are best used for short to medium-term objectives or as an emergency reserve. They offer a secure and convenient alternative for anyone who wants to protect their wealth while still reaping the benefits of compound interest. Additionally, some high-yield savings accounts include the ease of internet banking, making it simple for people to monitor their progress and manage their money. Stocks. Stock and equity investing is a well-liked long-term method for creating wealth through compounding. In the past, the stock market has consistently outperformed the majority of other asset classes over time. Over time, businesses that consistently grow, have solid financials, and have a competitive advantage typically provide greater returns. You can take advantage of compounding by investing in a broad portfolio of fundamentally sound businesses. Stocks have delivered 7 to 10% yearly returns on average throughout the years. For instance, if you put $10,000 in a diverse stock portfolio over the course of 10 years, assuming an average annual return of 8%, your investment may increase to about $21,589 after that time. Dividend-paying stocks. Stocks that pay dividends are those owned by businesses that pay dividends to shareholders as a way of sharing their profits. These stocks are desirable compounding assets because they have the ability to increase in value, generate consistent income, and generate passive income. Here are some ways dividend-paying companies might help you build wealth. Dividends are normally paid out every quarter or once a year, giving investors a steady income stream. This revenue can be invested again to buy more shares, hastening the compounding process. Companies' dividend yields differ, and a higher yield indicates that a greater portion of the stock price will be distributed as dividends. Stocks that pay dividends can also increase in value. The stock price often rises as the business expands and becomes more successful, resulting in financial gains. Investors can profit from the compounding effect on both income and capital gains by reinvesting dividends and letting the shares appreciate over time. You should take into account elements like dividend yield, payout ratio, and the company's financial stability in order to approach dividend-paying companies in a balanced manner. Choosing well-established businesses with a history of regular dividend payments and a track record of raising dividends over time is a wise strategy. Companies that have increased their dividends for at least 25 consecutive years are known as dividend aristocrats, and they are frequently regarded as solid investments. Let's take an example to demonstrate the possibilities for wealth growth via dividend-paying equities. Let's say you put $100,000 into a diversified investment portfolio that pays dividends. 3% is the portfolio's average dividend yield. This implies that for every $100,000 invested, the investor may anticipate receiving $3,000 in dividend income each year. The cumulative effect becomes apparent over time. With an average yearly stock price increase of 5% throughout the course of the investment's 20-year holding period, you stand to generate significant growth earnings of $278,647. Real estate. Investing in real estate has shown to be a profitable compounding asset. Real estate investments, especially rental properties, can produce a steady cash flow, and because property prices often increase over time, they present an alluring chance for wealth compounding. You can reinvest rental money from assets to buy more properties, further diversifying your real estate portfolio and raising prospective returns. Real estate investment trusts, REITs, also offer the chance for compounding and passive real estate investment. For instance, you might pay $40,000 as a down payment on a $200,000 rental property, get a mortgage for the remaining $160,000, and then pay the entire $200,000 over time. After 20 years, the total return on investment may be more than $500,000. This is based on the assumption that the property earns a net yearly rental income of 6% or $12,000, and that the property value increases at an average rate of 3% annually. You can use the compounding effect to amass considerable wealth over time by reinvesting the rental revenue and keeping the property. Bonds. Mutual funds are debt securities that are issued by governments and enterprises to raise capital. Even though they frequently offer lesser returns than equities, bonds are nevertheless thought of as safer investments. In the form of interest payments, bonds provide a steady income stream that can be reinvested to increase wealth. Bonds give a portfolio stability and act as a hedge against market volatility. When investors reinvest interest payments, bonds have a compounding effect that increases the investment over time. By reinvesting interest, which creates interest on interest, investors can benefit from compound growth. Precious metals. Adding gold and silver investments to a diverse portfolio might be a wise move. Precious metals have a history of holding their value and being useful, especially during times of economic turbulence. Despite not producing consistent income like dividend-paying stocks or bonds, their value tends to increase over time. A minor allocation of precious metals to one's investing portfolio is frequently advised as a hedge against inflation and market volatility. The precise percentage allocation is determined by each investor's risk appetite and financial objectives. Typically, it is advised to devote between 5 and 10% of the portfolio to precious metals. For instance, if an investor decides to invest $50,000 in precious metals out of a $500,000 investment portfolio, they may want to think about buying physical gold or silver bars, coins, or exchange-traded funds, ETFs, that track the price of these metals. Assuming a 5% yearly return over a 20-year period, the investment might possibly increase to about $132,676. Investments can compound and help a portfolio increase overall over time as the value of precious metals rises. Although precious metals provide stability, it's crucial to remember that their prices might fluctuate. Therefore, experts advise retaining precious metals as part of a diversified investment plan, rather than relying primarily on them for wealth growth, and recommending a long-term investment horizon of at least 5 to 10 years when investing in them. Investors should also take into account the expenses related to storing and insuring real metals. Exchange-traded funds, ETFs, and index funds. Exchange-traded funds, ETFs, and index funds are investment instruments that follow particular market indices. They provide diversification across a variety of assets, including commodities, equity in commodities, enabling investors to profit from the expansion of the market as a whole. These funds frequently follow a particular market index, giving exposure to a variety of equities. Index funds and ETFs can compound gains over time and build long-term wealth through regular contributions and dividend reinvestment. Index funds and ETFs have historically produced average yearly returns of between 6 and 8%. Let's imagine a $20,000 investment in an index fund with a 7% yearly return as our baseline. Your investment might potentially increase to almost $67,275,000 after 20 years. You can use the compounding effect to create significant wealth if you continually reinvest the income and keep a long-term investment strategy. Retirement accounts. Contributing to retirement accounts, such 401k, Es or individual retirement accounts, IRAs, provides tax benefits and the chance for compound growth. By consistently setting aside a portion of your income for retirement accounts, investing in a wide portfolio of assets, and taking advantage of tax deductions, you can amass wealth within a tax-efficient framework. Employees can make pre-tax contributions through automatic payroll deductions to employer-sponsored retirement plans, or 401s, which reduces their taxable income. For instance, John contributes $5,000 to his 401k each year from his salary of $50,000 or 10% of his annual income. Up to 6% of his pay, his employer will match 50% of his contributions, giving him a total match of $2,500 more. John's total contributions of $225,000 over 30 years, assuming an average annual return of 7%, may possibly increase to about $71,787,000 or $175,065 over that same period. Individual retirement accounts, or IRAs, are ones that people can create on their own. There are two types of IRAs: standard IRAs and Roth IRAs. Standard IRA contributions are made with pre-tax money, which lowers current tax obligation. Roth IRA contributions are made with after-tax money, but eligible withdrawals from an IRA in retirement are often tax-free. For the sake of illustration, consider Sarah contributing $5,000 annually to her traditional IRA for 30 years. Her donations of $150,000 might increase to around $550,000 if the average yearly return of 7% is assumed. The wonders of compounding bring forth numerous benefits that can significantly enhance your financial well-being. 1. Exponential growth. Embracing the power of time, the earlier you commence investing, the greater potential for your investments to grow exponentially through compounding. As time progresses, the compounding effect accelerates the accumulation of wealth, even with modest investments, paving the way for substantial prosperity. 2. Passive income. Compounding allows you to cultivate passive income by reinvesting your earnings. This perpetuates a cycle of generating additional returns without the need for active effort. Witnessing your passive income grow steadily over time provides financial security and freedom. 3. Inflation hedge. Compounding serves as a shield against inflation, safeguarding the value of your money. Investments yielding returns above the inflation rate help preserve your purchasing power despite the erosive effects of inflation. 4. Psychological advantages. The psychological impact of observing your investments flourish over time instills discipline and patience. It reinforces the importance of remaining invested and avoiding impulsive decisions based on short-term market fluctuations, a vital mindset for achieving long-term financial success. Compounding stands as a potent wealth-building tool, propelling individuals toward their financial aspirations. By grasping the principles of compounding and strategically investing in compounding assets, such as stocks, real estate index funds, bonds, or retirement accounts, you can unlock the potential for substantial long-term wealth. The key lies in commencing early, diversifying investments, and reinvesting earnings to harness the full power of compounding. Remember, patience and a long-term perspective are essential for success on this journey. Take charge of your financial destiny and witness your wealth flourish. If you resonate with this perspective, don't forget to show your support by liking and subscribing for more insightful content. Here's to your financial freedom and a wealthier tomorrow through the magic of compounding.